I first bought shares of Apple on June 28, 2013. At the time, I paid $56.62 per share on a split-adjusted basis. I bought more in 2018 for about $170 per share and again in 2019 for $142 per share. You could say that Apple been very good to me. Last week Apple announced blowout earnings and profits. On top of that, it announced a 4-for-1 stock split, which usually sends the market into a frenzy for no good reason. On Friday its stock jumped more than 10%. Today it jumped another 52%. I was convinced it would fall today after the big climb on Friday. So much for my technical analysis. Apple now comprises 53% of my portfolio as reflected in this screenshot from my favorite investment tracking app. This allocation comprises the Apple shares I own and the shares owned through index mutual funds. What it doesn't account for are the Apple shares I own indirectly through my ownership of Berkshire Hathaway, via index funds and shares of BRKB. As a result, Apple stock comprises more than 16% of my portfolio. Even those who stick with index funds aren't safe from Apple's meteoric rise. Apple currently accounts for about 4% of the S&P 500. Add in Microsoft and the two dominate the index with a share of over 12%. And Amazon and Facebook are not far behind with nearly 5% and 25% share respectively. Top it off with Alphabet and you have roughly 20% of the index concentrated in 5 companies. All of this raises important questions for investors. The price-to-earnings ratio (PE) of Apple currently stands at about 33, according to the Apple Stock app. By historical standards, that's rich. Of course, that's nothing compared to Amazon, 120. Still, Apple hasn't seen a PE that high since 2007, and we all know how that ended, although Apple survived just fine. The PE ratio doesn't tell the whole story. Apple has experienced remarkable growth, profitability and cash flow. In its latest earnings release, it disclosed that earnings per diluted share rose by 18%. It experienced double-digit growth in both products and services. Its operating cash flow came in at $16.3 billion. It seems Apple's biggest problem is figuring out what to do with all of its cash. As remarkable as these numbers may be, they still don't tell us whether Apple stock is fairly priced. I've always viewed intrinsic value as a range, not a number. And in my case, it's usually a very wide range, which is why I pass on so many investments. Sorry, Amazon, you're too expensive for me. Given current interest rates, and that's an important caveat, I think Apple stock is on the high end of its intrinsic value range. I'm certainly not selling my shares of the company. Of course, don't confuse valuation with a prediction of future stock prices. Price targets tell you more about the person making them than the value of the company. This question is important to index fund investors, and the short answer is no.